Many of you have asked me about my opinion on Netflix stock. The stock is down 31% over the last 6 months. Absolutely crazy. I've done many videos on Netflix, and this one I'm gonna combine everything all in one. I'm gonna evaluate with the merger, without the merger, give you my fair value, and tell you why I believe Netflix is starting to get too cheap to ignore. I said it was overvalued at 110, but right now Netflix is getting very, very interesting, and I would call the WBD acquisition more of a call option, additional upside on the stock. So I'm not gonna focus on the quality of the company. I'm gonna talk about valuations, and I really hope you enjoy it as always. Now, funny enough, Netflix did put up a bid to acquire WBD for about $82 billion, but since then the market cap has declined by more than $200 billion. So it's almost priced in 3 times the acquisition of WBD. And the market clearly believes that Netflix did indeed overpay for the acquisition. But now again, it's looking much, much better. Now, if the acquisition does go through, it's going to give Netflix an amazing library of content like Batman and Superman and Shark Week and Game of Thrones and Harry Potter. And there's so many legacy brands that Netflix can monetize, and that's why Netflix is acquiring WBD. They're not doing it for HBO Max, they're doing it for the library of content that they can monetize, and this library is amazing. Now, the approval process is still in place. It has not been 100% approved. It still has to be approved, and there was a Senate hearing related to the merger, and the senators, they were not too happy with the mergers. They're not optimistic about it. They tried to tell Netflix that they want a 45-day theatrical period for those films to be released in the theaters before they go on the website, and they agreed to that. And Netflix CEO said that combining the two companies would give consumers more content for less. The senators disagree. They said the deal would consolidate too much power in the hand of one company, and this company will have the increased control over what we see, what we hear, and what news we consume. And I 100% agree, and I still believe the merger is not going to get approved. I've been saying it for a while, and I'd be surprised if it gets approved. But I'm gonna use both case scenarios for Netflix. Now, for Netflix, or I should say for WBD, they still paid $82.7 billion for the acquisition. They were trying to fund about $11 billion of it through equity, but now the stock has declined so much that Netflix doesn't want to dilute at such prices, and I agree with them, which is why it's gonna be 100% cash and debt offer, and they're not going to be diluting any stock, which is really good for shareholders at the current price. Now, they valued the acquisition at about 14 times EBITDA. This is with a lot of synergies that could happen, and I always said that a lot of companies, they overestimate the synergies. It happens a lot. It happened with so many companies. By using without the synergies, they pay 25 times EBITDA, and this is for a company with no growth like Warner Brothers Discovery. So the market definitely believes Netflix has overpaid, and that's why the stock has declined so much over the previous months. Now, the trick with this acquisition is it's unlikely to go through before 2027. So maybe 2027 is gonna go through, or let's say maybe even this year in 2026, okay? Now, it says that they don't expect earnings, or should say GAAP earnings accretion before the second full year. So if it goes through in 2027, you're not going to see the benefits of WBD before 2029. This is a long way for you to see any kind of benefits. And those kind of synergies, they don't expect them until by year 3. So maybe by 2030, you're going to see the benefits of the merger. And again, that's why the stock has been declining. There's a lot of uncertainty, and there's no clear path forward for Netflix and what's going to happen with the merger. Now, I did some calculations for you to determine how much are you paying for the merger combined if you're buying Netflix today. Netflix today is trading at $357 billion enterprise value, which includes debt and cash. It includes everything. WBD, they paid about $82 billion. Combined is about $439 billion. The EBITDA of Netflix, I put it in at $20 billion because the acquisition is unlikely to go through before 2027, and the analysts are expecting EBITDA to jump from $13 billion to $20 billion by 2027. So I'm using $20 billion for Netflix. For WBD, I'm using $3.3 billion, which is pre-synergies, as the synergies will take 3 years to be realized, so not before 2030. So we're using $3.3 billion. Combined, we get $23.5 billion in EBITDA on a $440 billion enterprise value valuation. We're paying right now about 18.8 times EBITDA for the merger. This is much better than before. When I previously valued it, it was at 25 times. That was ridiculous. 18 times right now, it looks really, really good. And if Netflix gets to the low 70s, you'll be paying about 15 times EBITDA for the combined companies, and it would be really, really cheap. So I believe right now, if you're betting on the merger, I think you're really paying a fair price if you're buying the merger together with the synergies and everything, about 18.8 times EBITDA. It's really fairly valued, and it's really not bad at all, in my opinion. Now, Netflix alone is an amazing company, and the PE was about 50 times forward earnings. That's not trailing. It was forward, 50 times forward earnings. Now trading at 25 times earnings. This is a much more reasonable multiple. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you want to use my link in the description. But now trading at 25 times. The average is like 30 times. This is a much better multiple for a company like Netflix. The analysts are still expecting massive earnings per share growth. 27% was in 2025. 2026 expected 23%, 22%, then 17%. So I did a valuation model on Netflix. I put in the current earnings per share. I used 20%, 20%, 20%, then 15% and 15%. And many of you have asked me, why are you putting in 15 and 20% if the company is only growing revenues 10%? Well, this is because the company's margin expansion, the margins have been expanding. And if the company's margins are expanding, earnings per share will grow faster than revenues. So that's why I'm using a higher earnings per share number. Now, if I use those estimates, the current trailing PE is 34 times. Normally, Netflix trade on an average about 30 times earnings. Now, if the uncertainty is gone and Netflix gets back to 30 times earnings, the return today would be about 118% on the upside, or about a 17% annual return with an amazing company like Netflix. And to me, this is really a good return. It's not bad at all. Now, my only fear is that maybe Netflix, due to the uncertainty in general, a few years from now, maybe they're not going to be growing as rapidly as they're growing at the moment, and maybe Netflix is going to command a 25 times earnings multiple 5 years from now. That could very well happen. Now, if it does command a 25 times earnings multiple, then for you to get it double over the next 5 years, you would have to buy Netflix at $73 per share. Now, which is only like 9% from here. So for me personally, I believe Netflix's setup is looking very, very interesting. If I'm valuing it with the merger, it looks undervalued. Without the merger, it looks fairly valued. And it's with between 9 to 10% within what I would call too cheap to ignore. So the setup is much better. If you like Netflix here, I would research the company and potentially dollar cost average down. But I really like the stock, and I haven't bought the company yet. I've been buying other stocks in the market, but I might potentially buy the stock. Maybe if it gets to $75, I will not be able to ignore it. And that's just my opinion on Netflix. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.